Welcome to NAAIM Confidential, episode 31. I'm the host, Ryan Redfern, and today we have Nathan Bremer, CFP and AAMS from Eighth Wonder Investments. Awesome guy to get to know around the NAAIM community. He's more on the financial planning side, so we're going to do a little more dive into that today, and we'll see where that takes us and how to pair investment strategy with financial planning. I think that's always a great conversation. So we're going to start off with the NAAIM Exposure Index. I'm going to share that. And currently this week, we are at 75 after a very, very choppy week. Personally, I was at 50, so I don't know who else was more invested than me, but that's where they were. Nathan, you're a part of this index as well. Where were you at on this
I
scale?
am. Yeah, I believe we were, if I remember right, I think we were at about 80 or 85
Okay,
this week. So definitely on the higher side than you and even the rest of the community.
gotcha. So you're kind of the balance between the two of us.
Right? Yeah, I like that.
Right, right. So the model that you report to this strategy, is it an all in, all out? Does it have steps? How does it act? What might you report typically?
Yeah, so that's a great question, Ryan. I think typically we're on a smaller range than probably most people. We're probably, I mean, for sure topping out at 100. We don't use any leverage to go beyond quote unquote fully invested. So typically we're just looking at kind of our cash levels and where those are sitting. So I would say 70 is probably on the low end for us.
Okay.
So right now being at 85, we're pretty neutral for us in our way we report to the name exposure index.
Perfect, perfect. So that's a tight little range, but
It
but
very
there's
tight.
takes all types. I mean, there are some that are negative 200 one week and then positive 200 the next week. So it's
Right.
I mean, personally, I think I'm between 190 plus and negative 80 is my
Mm-hmm.
range. So being at
Yep.
50 is kind of similar to you. We're kind of that halfway part. Not all in, not
Mm-hmm.
all out. It,
Yep.
it really didn't get that bad as we, at least from the data side. I mean, the Nasdaq
Mm-hmm.
got crushed and it was terrible, but so much of the data just didn't really say it was going to be, this isn't it. This isn't the sell off, at least not yet. Um,
Yep.
are you seeing
Exactly.
anything different or similar?
Yeah, for sure. It was funny Sunday night going into the market open. You could see that things were probably going to be a little bit choppy. So
Yeah.
the Asia open was not great, and that was probably going to reflect in our markets on Monday morning. Wake up Monday morning and see the VIX spiking up to 65. And
Oh, no.
first thing I'm doing is getting on and writing an short email out to clients, essentially saying, "Don't panic. This is not time to freak out, even though everyone else is." And it's funny with all the volatility. We get the third highest VIX on record, and the S&P was down 4 basis points this week. I mean, if you would have told me that on Monday, I would have not believed you. Uh,
No.
and yet we're only down 6% from all-time highs on the S&P. So
Yeah.
kind of strange to have this level of volatility in a near all-time high market.
Oh, absolutely. Yeah, it makes no sense. And that spike in the VIX was kind of crazy that we'd only see every so many, few years. I think 18 was the last time it really spiked. I guess COVID did
2020.
2020
Yep.
did as well. But it's
COVID.
it's every couple of years, and it's
Mhm.
usually on a bigger sell-off than this, which I thought was odd.
Right, for sure. And I felt the same way. That's why it was definitely different. I mean, maybe a signal of more volatility to come in the next few weeks is very possible. But yeah,
Right.
just interesting that it didn't play out this week any differently than it did.
Oh, for sure, for sure. And I like that. I too did a newsletter or an email blast to our clients on Monday. We actually did some big selling on Friday beforehand. I don't, just
Hmm.
the signal said to do it, so we did. Which
Yep.
that worked out very well. So can't
Hmm.
complain. But yeah, you still have to stay in front of people and let them know what you're doing, what you're thinking, why they're
Right.
investing with you. I think that's very, very key. So
Yep, exactly. Especially during those times of turbulence
yeah.
to let people know that they're going to be okay.
Absolutely. No, I love it. I love that you do that. It's a good reminder to people watching, advisors, you stay on top of these things. It really, really does a lot for your business. So
Yep.
let's talk about you. Let's dive into your approach. I think you have some slides. So if you want to share your screen, let's talk about Nathan. What makes you
Yeah,
awesome?
for sure. Let me get that pulled up here. Are you able to see the slides?
Yep. Yep.
Perfect. So we'll get started here.
So you're a
Uh,
CF. Let's go. I
yeah,
can
go
leave
ahead.
slides up, but you're a CFP and an AAMS. So why did you pick those two designations?
Yeah, great question. CFP, the reason I chose CFP was because it's essentially the gold standard as far as financial planning accreditations. So anyone that has a CFP or is interested in CFP, in my opinion, it's the one to get that stands out the most. It has, in my opinion, the most recognition widely amongst clients, which is a big deal since that's largely why you're doing it. Plus, it does incorporate tons of good education that's really important that you would want an advisor to have. Focused on financial planning as well as ongoing education requirements and ethics requirements. So that's why I chose CFP. For the accredited asset management specialist, which more people are not as familiar with. That one has more to do on the investment management side. So I chose that one as essentially showing people that I do both the planning and the
Right.
investment management, and that we're able to combine those into our practice. So kind of one designation for each side of our business that work hand in hand.
Right. Love it. No, CFP is very broad. And I have the CHFC myself, and you go through all that
Mhm.
same stuff and it's brutal. I couldn't imagine doing that comprehensive test at the end. So I'm glad people like you are braver than I am. And I'm just like, no, can't do it. And I like
Yeah,
that you guys manage your own trades yourself. So you're not outsourcing that. It's your own, as I say, eat your own cooking
correct.
kind
Yep,
of shop.
exactly. We manage our own model portfolios. So we typically own between in those models between about 30 and 40 individual securities.
Okay.
And our little bit about our philosophy there is rather than owning, say, the S&P 500, where you own a basket of about 500 large companies, we want to be a little more selective and try to choose the higher quality businesses out of those, with good long-term tailwinds is a big factor, and then just high quality, durable businesses, so that we're really focusing and putting the bulk of our assets into those companies versus just spreading out our bets amongst 500, even though
Sure.
the S&P is very concentrated. Um, Another way we like to think about that is a sports analogy would be, would you rather put more Michael Jordans on the floor or the last guy on the bench? And we want to
Love it.
focus on the Michael Jordans, the Tom Brady's
Mhm.
of companies versus just buying any random player.
Love it. Love it. So I know you had a disclaimer, and then we're going to dive into your approach. So yeah, I'll let you do that.
Perfect. So standard
Before I,
disclaimer,
yeah, go ahead.
just pass right through that.
Perfect.
Um, Yeah, so our approach talked a little bit about that, as far as the investment philosophy, but then also hand in hand combining that with the financial planning aspect of things, really focused on that for our clients to understand their financial situation, to understand where they should be investing, what types of accounts they should be investing in, from a tax perspective, from a long-term plan perspective. And then I think a good part of where those two go hand in hand is, even things as basic as timings of Roth conversions, for example. Market comes down 20%, might be a good time for people to consider conversions because the assets are discounted. So you're going to pay taxes less on that conversion than you would be at all-time market highs, for example. So that's just one very basic example of how we kind of combine those two, but tons of ways to combine those. And then also just trying to keep things as simple as possible when it comes to both our planning and our investment management. From a planning perspective, things get very complex very fast. So we try not to overcomplicate things, especially when it comes to things that we need our clients to do. Trying not to overwhelm them with a list of 20 things, 20 to-do items to send them off with. It's often overwhelming for people that don't live in our world to go out and check those things off a list. Typically, they just don't get done if they're overwhelmed. So trying to take things in bite-sized pieces for them. And then also when it comes to our investments, trying to focus on really on the big picture and not get too granular of trying to be trading in and out on a day-to-day basis. So we're not, market timers per se, when it comes to the actual investments that we manage. More so on the planning side, where I gave the Roth conversion example.
Right.
That's something where we want to be quote unquote timing the market, but not for market purposes, but for planning purposes. So yeah, like I had mentioned earlier, we really just want to focus on the best companies that are publicly traded and kind of just ignore the less quality companies, we'll say. Makes things easier on us, and we think it makes us better investors in the long run.
So is there a universe that you pull from, like just the S&P, the Nasdaq, small,
Yeah. So
what are the
we're
what are the criteria? Yeah.
yeah, so we're not restricted as to our universe, which is one of the great things that we think helps us do better than competitors, is that we're not limited to say a certain percentage in a certain industry or
Mhm.
index or something like that. So it gives us that flexibility to really be anywhere we see best fit. Typically, we're sticking with S&P 500 companies, large cap, mostly US, some international exposure as well. Um, so yeah, we're not limited to where we can go. And we don't really have, like I say, guardrails on we can only own 20% tech or anything
Okay.
like that. So if we wanted to be really overweight tech or any sector, we can do that. Or if we want to switch from owning the very large cap mega cap techs to more mid cap companies, mid cap industrials, we can kind of do that as we see fit.
So that would change as the economic environment changes as to where the strength is.
Right. Yep, for sure. And we're not, again, market timing, so we're
Mhm.
not necessarily making major changes all the time, but as we see things might be changing, tides might be turning, we might kind of shift the balance back to where we think things should be.
Mhm. And that really is still a form of active investment management. I find it too often the group of name we're always thought of as just market timers. We're just in and out, in and
Hmm.
out. And that's just not really the truth when you really dive in and start meeting people who are part of this membership, like yourself. I mean, you're mostly in most of the time, just making little
Right.
tweaks here and there, but that's still active. It's not
Yep.
buying an index and saying, "Great, good luck out there."
Yep, exactly.
Once
Yep.
again,
So
years.
that's what we like to tell our clients, we have an eye on the markets for you. So there is somebody that's aware of what's going on. Even in a market downturn where, we had 2022 is a great example where everything was down for most of the year.
Yeah.
Um, and we were pretty much along for that ride. But then using that weakness to continue to add to positions in the best businesses in the world, and really focus on continuing to own those companies. And then that's since paid off rather quickly, getting
Mhm.
back to all-time highs. And it's one of the really interesting things about public markets is one of the best benefits of the public markets is how liquid they are, and that you can see the price of anything at almost any time and buy something 1 minute, sell it the next. But oftentimes it's more of a distraction than it is a positive for people. You think if you went out and bought a small coffee shop, you wouldn't think about selling it 5 minutes later. You would probably have a plan to hold it for
Mhm.
5 or 10 years at least. And another way to think about that is imagine every person that comes up to buy a cup of coffee, imagine they give you a price and say, I'll buy your coffee shop for $5. And then the next person comes up and says, I'll give you $5.50. Well, do you sell because that person offered you more? Is your business now worth more? Um, so, it's kind of counterintuitive how most people view the markets. Most people do the exactly the right thing at exactly the wrong time, where people see stock prices go up, and that's when they get excited and say, "Oh, let me hop on this train." And then we get a 20% correction. And the very opposite of that, we get that 20% correction, and the people that bought say, get me out of here. I just lost 20%. I'm done. I can't take the
Yeah.
pain. So it's interesting how that works. And we try to coach people to do the opposite and
Mhm.
really treat their shares as what they are, as a stake of ownership in
Mhm.
an actual company that makes money.
Nice. Very good. Good explanation. And then you got a quote you snuck in here early. Everything
Yeah,
should be
so
it's as simple as possible, but not simpler.
right. So that's kind of our mantra when it comes to just about everything, is really trying to not overcomplicate things. Like I said, both in the planning world and the investment world,
Mhm.
things can get complex so quickly. Just trying to take the approach of not missing the forest for the trees, essentially. When it comes to everything we do, just trying to always see the big picture, big picture financial plan. Another example is, most people go get their taxes done. They bring their information to their tax guy. Their tax guy does their taxes. They maybe meet and say, how can we lower our taxes? Well, the tax guy is going to say, contribute more to your retirement savings, your 401k. Well, that's great. They're telling you how to save more in taxes next year, but what about your entire lifetime?
Yeah.
Um, and that's where we think most people should have a longer term approach, and saying, rather than how do I pay less in taxes this year or next year, how do I pay the least amount of taxes over my lifetime? So one example of that.
No, that's a great example. And that's a whole rabbit hole we can dive into. Maybe we will at the end. I'll keep that in mind. But I think you
Yep.
had an example you wanted to show us, so I want to keep the slides moving if that's all right.
Yep, absolutely. Let me hop over to that. So yeah, on this slide, we've got a 5-year look back, looking at two semiconductor companies that I think as of now most people are probably familiar with. We've got NVIDIA, the market darling of 2024 in green,
Yep.
and then Intel, the previous 2000 market darling, in blue. And what we can see is that over the last 5 years, NVIDIA has absolutely exploded, up over 2,500%, which is hard to even wrap your mind around.
Mhm.
Whereas Intel in the same industry is down 50% in that same time frame. So that's just kind of an extreme example of what we say when we want to own the best companies with the best fundamentals, the best long-term prospects, and try to avoid the Intels of the world who are, um, not doing so hot, to put it kindly.
Right.
So that's just a very extreme example, but just one that kind of shows more of what we aim to do with our investment philosophy.
Sure. And are there any key characteristics or stats or specs that you're looking for in your stock picks?
Yeah, that's a great question. I think one of the biggest things is just looking from almost an outside perspective of, if you ask someone on the street, what would you look for in a company that you wanted to buy and become an owner of? And some of those basic things are things like revenue growth. Is the company growing? Um, Earnings per share growth, operating income growth. Is it profitable? How profitable is it? Return on invested capital is a big one that I really like. Looking at the balance sheet is another huge one. You've got a lot of companies out there with crazy good balance sheets. I mean, balance sheets that would put countries to shame.
Right.
And then you've got others that are, I mean, just absolutely saddled with debt that might benefit from lowering interest rates, but in the long term, they're still saddled with debt. So we really want to buy high quality companies in that sense, and companies that logically make sense, that will continue to do well into the future.
Gotcha. Gotcha. And in that, do you look for smaller companies that you're expecting to grow into the next big companies, or is it more of the big, cash moats, as they say, and the big
Hmm.
those kind of companies?
Yeah, we're more focused, at least right now, on the companies that are already bigger, that are
Right.
already just cash generating machines,
Right.
um, versus trying to pick those next ones. And I think part of that has to do with just the general market dynamics that we're seeing, where in the past, a lot of companies came to the public markets at a smaller size where you could get in earlier, whereas now those companies are coming to market much later where they're already large cap companies by the time they IPO. So I think that has a lot to do with it. Companies staying private a lot longer until
Okay.
they're, um, reaching that tipping point. So you're not really seeing new Googles or Amazons or Metas coming public,
Right.
at least that we know of right now. Maybe we'll look back in 10 years and say, oh, we had these companies that were exactly that. But we're not really seeing that, and we haven't really seen much of that since those companies came public.
Right. Right. Excellent. Excellent. Well, what do you got next? I think you've got another little chart here. There we go.
Yep. So this kind of gels with our philosophy of owning those great companies, as well
Mhm.
as making sure that people understand that how long you're investing plays a huge role in how successful you'll be. What we've got here, it's kind of a noisy chart here from JP Morgan, but what it's showing is the green bars is showing your stock return if you're 100% stocks. The blue bar is showing if you're 100% in bonds, and then that gray bar is a 60-40, 60% stocks, 40% bond portfolio. You've got the average return is the on a 1 year, 5 year, 10 year, and 20 year rolling basis. And what we see is that in that far left bar, we see that stocks, 100% stocks, are volatile in any given year. You could be down as much as 37% if you had the worst timing in the world, and up 52% if you have the best timing in the world in any given year. And if you shift over to that far right cluster of bars, we can see that on average over 20 years, stocks are going to perform at about 6% at their worst over any 20-year time frame, whereas bonds are actually only up 1% at their worst. So stocks, as crazy as it seems, stocks in their worst years perform better over that time frame than bonds perform over their worst years. And then also on the flip side, stocks are up 18% in their best 20-year rolling period versus bonds up 11%. So essentially what this chart is showing is that the longer you own stocks, the less risky they become, and can even become, according to this, less risky than owning bonds, which most people don't know or understand.
Right.
So I think that's a really good one to show. We really like to focus on working with people that do have long-term time horizons that can withstand market volatility, and that have plenty of cash on the sidelines to cover their day-to-day expenses,
Right.
as well as get through, a multi-year market downturn.
Great. And previously we were talking more about your stock equity portfolio. Do you do any bond investing, or do you do a 60-40 or different risk levels for different clients?
Yeah, we don't do anything currently with like individual bond selection. If
Okay.
we did have someone who wanted to have some bond exposure, we would just use an ETF for
Right.
that currently, is how we would manage that. But ideally that's not where we want people.
Okay.
Even though we do anticipate bonds doing pretty well with anticipated lowering of rates
Yeah.
upcoming.
Oh, for sure. For sure. Interesting. So all your investors are really just all in on your equity model.
Right. Yep, exactly. And like I
Okay.
said, just making sure that we're not necessarily 100% in at all times, or
Uh-huh.
especially
Sure.
within the context of their larger plan, making sure they have um, enough cash to cover so that they're not having to pull from their investments when markets inevitably come
Right.
down 20+%. So we're trying to prepare people for that, and teach people to expect that. Those 20% plus bear markets are actually quite common, as you know.
Yes.
And we want to be prepared for them because we know that they've happened in the past. They will definitely continue in the future, but stocks are still the best place to be over the long term to get the highest rate of return.
Like it. No, that makes a lot of sense. So do you have, and this is more on the planning side, but do you have clients who are taking out certainly annual distributions to live on from your models? And how do you deal with that if you have to have cash set aside to be paid out?
Yeah, definitely. So typically that's something that we'll try to be ahead of the game on. So
Mhm.
when things are well, we're maybe doing a little bit of selling for them and raising some cash for them for that distribution, as well as maybe moving into a more conservative model so that they're not as high beta when the market does have those downturns, so that they're not
Right.
affected as much. So maybe in a 20% drawdown, maybe they're down hopefully a little less than that in a perfect scenario, as well as having that extra cash on the sidelines ready for those distributions.
Mhm. Got it. Got it. No, that works. I mean, there's a lot of ways to come at it, and I think it's always interesting to hear it. I know we keep typically we call it the 1 year bucket of
Hmm.
cash in a money market or whatever they need. So I know that that's ready to pay them monthly or quarterly, whatever they need. But then I also have a system to say, okay, the market's relatively is strong right now. Now I want to pull a little money and fill that bucket. So
Hmm.
I'm filling it on my terms, not on their terms, and
Yep.
it helps the longevity of your plan.
Yep, for sure. And we kind of take a similar approach where if we see things getting a little frothy, we
Yeah.
might fill that bucket up a little bit for,
Yep.
and maybe it's multi-purpose. Maybe it's because they do have, some upcoming cash needs that we know that
Yes.
we're going to need some cash for. And maybe it's, hey, we think the market's a little frothy.
Yep.
Um, let's maybe put a little more cash on the sidelines and get ready and
Yep.
hopefully get a little bit of a drawdown so we can buy those same companies at a little bit lower prices.
Exactly. Exactly. Cool. And I think you have something in the planning vein you wanted to move on to next.
Yeah, let's hop into that. So what we've got here is just a little bit on the Secure Act. I'm
Mhm.
sure most people have heard of the Secure Act, but don't fully understand everything that it did because the Secure Act and the Secure 2.0 Act changed a lot of things for a lot of people. Um, but really, the biggest one that I see is the elimination of the stretch IRA for most non-spouse IRA beneficiaries. Um, in the past, what would happen is that if you were, say, your parents had passed away and you inherited an IRA that they had, you would have the rest of your lifetime to take your required minimum distributions, so that the government can finally tax those dollars that have never been taxed before, which seemed to work out for most people. Most people within their financial plans had kind of built that in as an assumption, which typically didn't affect too many people because those required minimum distributions weren't that high for most people. So you could stretch it out for
Mhm.
40, 50 years in some cases, maybe even more. So it wasn't like you were forced to take out a ton from that IRA each year. Whereas now, if you are a non-spouse IRA beneficiary, in most cases, you will not qualify for that stretch IRA anymore, and you'll be subject to what's called the 10-year rule. So you will have, instead of the remainder of your lifetime to take out small chunks of that IRA and pay taxes on it, you'll now have 10 years to take out that chunk of money. So imagine you inherit say $1 million IRA, which isn't that uncommon. You now have 10 years to take that out. Well, if you're in your peak earning years on top of that and already in a fairly high tax bracket, you're just adding $100,000 a year if you spread that out evenly with no growth. Um, and having to pay income tax on that. So, I mean, you might be paying close to 50% in income tax on that IRA that your parents had thought would come to you almost tax free.
Right.
So there's a lot of changes. I think that's really the big one, and there's a lot of other
Mhm.
implications when it comes to what has happened with the Secure Act and retirement. Um, and the biggest thing is I would venture to imagine about 99% of people have no idea that this
Mhm.
even changed.
Yes.
And I think it's something where we're going to see people are upset and confused when it happens to them, and without having any planning in front of it on the front end of it, people are going to be very, very surprised and upset when they are forced to deal with it.
Yeah. And we're getting up on time. Wow, this has just been going great. I feel like we could go another half hour easily. So do you have
Completely
a
agree.
quote that you want to share with us? I know you snuck one in earlier, so you got a bonus. You did a
It,
twofer.
yeah, I had to do a twofer. I thought it was fair game since I
It is.
chose from the same uh, person who gave this the quote was Albert Einstein. Same one on this one. So favorite quote, which is where we get our name from at Eighth Wonder Investments, is that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And we think that's a pretty succinct way of summing up what we do. We help people take advantage of the eighth wonder of the world as coined by Einstein,
Right.
by allowing their investments to grow and compound over many years and trying to avoid things like credit card debt where you're
Yeah.
on the inverse of that. So that's our favorite quote.
Perfect. Love it. And you also have the how to contact you. Are you on any social media beyond this, or is this the
Yes, we do have Facebook and LinkedIn.
Facebook? Okay. Excellent.
Yep.
Excellent. Cool. Well, awesome. Well, Nathan, thank you so much for being here today. It was great getting to know you. Great to know your strategy. I love that there are more and more financial planners in the NAIM community because I think there is such great synergy between what we do and the planning. I think active managers, even as lightly active as you are, I mean, you're still active, but we can add more value to people's investment lives by doing little things instead of just the buy and hold. So thank you so much for sharing your stuff today, and we'll see you next time. And
Yeah,
thanks
thanks
everybody.
for having me, Ryan. I appreciate
All
it.
right, sounds good. See you next week.
Yep, take care.